Have you ever thought about how something really small, like a tiny seed, can eventually grow into this massive tree? Or how a little snowball rolling down a hill becomes, a huge avalanche? Well, today we're diving deep into a financial concept that works just like that. It's often called the eighth wonder of the world. We're talking about compound interest. Welcome to everything you need to know about finance.
Yeah, and just a quick heads up before we really get into it, what we're discussing today is purely for educational purposes. It's about understanding the principle. Definitely not financial advice, just a deep dive into how it all works.
Exactly. And hey, if this is the kind of stuff you find interesting, do us a favor and hit that like button and subscribe so you don't miss out. Our goal today is pretty straightforward. Break down compound interest. What is it? Why is it, well, so incredibly powerful? And how understanding it can honestly be a game changer for you wherever you are financially. We'll look at some really compelling examples and maybe some simple ways to think about it.
Right. We're trying to bring together different insights to show not just the what, but the really profound why behind its long-term impact. Hopefully it gets you thinking about how, time and consistency can seriously amplify your efforts.
Okay, let's get into it then. We hear compound interest thrown around quite a bit, but what does it actually mean, and how is it different from, say, simple interest?
Okay, so compound interest at its core is basically the interest you earn on your initial money, your principal, and on the interest that's already piled up from before. Think about that snowball again. It starts small, right? But as it rolls, it picks up more snow. And because it's bigger, it picks up even more snow, faster and faster. That's compounding. Simple interest, on the other hand, is, well, simpler. You only earn interest on that original amount you put in, period. With compound interest, the interest you earn gets added back in, becomes part of the base, and then that new, bigger base starts earning interest too. It's like a feedback loop.
Okay, maybe an example would help. Let's say you have $100, okay? And it earns 5% interest each year. So after year one, you've got $105. That's your $100 plus $5 interest. Easy enough.
Right.
But then, end of year two, this is where it gets interesting, yeah? You don't just get another $5. You get 5% on the whole $105. So that brings you to $110.25. That extra quarter. This doesn't sound like much, does it?
It doesn't. Not at first glance.
Yeah.
But that little 25 cents, that's the start. That's the interest on interest kicking in. And honestly, that tiny bit, that quarter, that's where the real magic begins to build up over time.
Yeah.
It seems small, but it multiplies dramatically. In fact, if you just left that $100 alone at 5% for, say, 10 years, you wouldn't touch it, add nothing, it would grow to over $162.
Wow.
And wait, stretch that out to 25 years, still not adding anything extra. You're looking at almost $340 from just the initial $100.
That really shows how it builds. So why? Why is this interest on interest thing so powerful? It almost feels, counterintuitive how fast it can speed up.
Well, the real power source here is that combination of time and reinvestment. The growth isn't steady like adding blocks one by one. It's exponential. That means the gains don't just add up, they actually multiply. Each year's earnings become the new foundation for the next year's earnings, making the base bigger and bigger.
So it accelerates.
Exactly. It accelerates. And that's precisely why someone like Albert Einstein reportedly called it the eighth wonder of the world. There's that quote, right? He who understands it earns it. He who doesn't pays it. It really captures the essence of it.
That's powerful. So for you listening right now, the big message here is the earlier you start putting your money to work, the more time it has for this snowball effect to really take hold.
Absolutely. Time is the secret ingredient.
Okay, let's make this even more concrete. You mentioned some examples that really drive home this power, especially the difference starting early makes.
Yes. Let's look at a scenario. Imagine 3 different people, okay? They all want to retire at 65, and let's assume they all get the same rate of return on their investments, just to keep things simple. So first, we have the early bird. This person starts investing at age 25. They invest consistently, but only for 10 years until they're 35. Let's say they put in a total of $120,000 over those 10 years. Then, crucially, they stop adding new money. They just leave it invested, letting it compound for the next 30 years until they hit 65.
Okay, so 10 years of saving, 30 years of just letting it grow. Got it. Who's next?
Next up is the late investor. This person doesn't start until age 35, but they invest consistently for 30 years straight, right up until age 65. Over those 30 years, they actually invest a lot more money, say $360,000 in total contributions. That's 3 times what the early bird put in.
3 times the cash invested. Okay, and the third one?
The third is the consistent investor. This person does both. Starts early at 25 and invests consistently for the entire 40 years until age 65. Their total contributions are the highest, let's say $480,000.
All right, so we've got the early bird, less money, more time. The late investor, more money, less time. And the consistent investor, most money, most time. What happens at age 65? This is the moment of truth, right?
It really is. And the results are, frankly, pretty mind-blowing. They show the power of time like nothing else.
Yeah.
Ready? The early bird investor, remember, only put in $120,000 over 10 years, but let it compound for 40 years. They end up with approximately $2,100,000.
Wow. 2.1 million from just 120K invested.
Exactly. All thanks to those extra years of compounding. Now, compare that to the late investor. This person invested 3 times as much money, $360,000, but only had 30 years for it to grow. They end up with approximately $1,980,000.
Wait, so they invested way more cash but ended up with less money than the early bird?
Less money. Even though they put in significantly more cash out of pocket, it really highlights that starting later costs them dearly in compounding time.
That's incredible. And the consistent investor, the one who did it all.
It's, the consistent investor. Started early, kept at it for 40 years, invested $480,000 total. They end up with a truly staggering $6,900,000.
Okay, nearly $7 million. That just shows the ultimate power when you combine starting early with staying consistent.
It really does. It demonstrates the full life-altering potential when you maximize both time and consistent contributions.
This is genuinely eye-opening. The key takeaway here seems less about how much you can scrape together later and much more about how long your money gets to work for you. That early bird really does get the worm, huh?
That's exactly it. It's not just about the amount. The duration your money compounds is critically important. Starting early gives you this massive, almost unfair advantage because time does the heaviest lifting.
So we've seen the incredible potential. Now, for people listening wanting to get a handle on this for themselves, are there any, quick tools or rules of thumb to estimate this growth?
Yeah, there's a really handy mental shortcut. It's called the Rule of 72. It's surprisingly simple. You basically just take the number 72 and you divide it by the annual interest rate you expect to earn. The answer tells you roughly how many years it'll take for your investment to double.
Oh, neat. So if I think I can get, say, a 9% return per year.
Right, so you do 72 divided by 9, which equals 8. That means, according to the Rule of 72, your money would roughly double every 8 years at a 9% return.
That's a really quick way to visualize it. Makes the long-term growth seem more graspable.
Exactly. It's not perfectly precise, but it's great for a quick estimate of that doubling power over time.
Okay, that brings up another point. We've mostly talked about interest being added, once a year. Does it matter how often the compounding happens, monthly versus annually?
Oh, absolutely. The frequency of compounding definitely matters. Interest can be calculated and added yearly, sure, but also semi-annually, quarterly, monthly, daily, even continuously in some theoretical models.
Right, I think some bonds pay out twice a year.
Exactly. Corporate bonds, government bonds often pay interest semi-annually. And the principle is, the more frequently the interest is compounded, meaning calculated and added to your principal, the faster your money grows. Because that interest on interest effect starts working its magic sooner and more often within the same year. It gives it a little extra boost.
Makes sense. So more frequent is generally better for savings and investments.
Generally, yes. Although it's also worth mentioning, this works on the other side too, with debt.
Ah, good point.
Yeah, think with credit cards, right? They often compound interest daily or monthly on outstanding balances. That's compounding working against you, making debt grow faster. It's interesting, though, something like a standard U.S. mortgage works a bit differently. It's usually an amortizing loan where your monthly payment covers the interest accrued that month, plus some principal. So the interest doesn't typically compound onto the principal balance in the same way savings might. It's a slightly different mechanism.
That's a useful distinction. Okay, so we've really unpacked this engine of compound interest. We've seen what it is, why it's so potent, those incredible integral examples. It feels like understanding this is just, fundamental for anyone thinking about their finances.
It really is fundamental.
Yeah.
And if you tie it all together, the message that just keeps coming through loud and clear is time.
Yeah.
Time is your single most valuable asset here. Those investor stories weren't just stories. They were data illustrating the massive advantage of starting now. Even if it's with small amounts, you want the longest possible runway for that snowball.
So bringing it back to the listener, what does all this mean for you when you're planning for the future? What should you take away?
Well, hopefully this knowledge gives you a sense of empowerment. It helps you make more informed choices, right? Whether that's about saving for retirement way down the line, or maybe a house down payment, or just building wealth generally. Looking at your financial goals through this lens of compounding, it can honestly shift your whole perspective. It makes you realize that those small, consistent actions you take today can have this truly monumental impact over the long haul.
It definitely reframes patience and consistency, doesn't it? They're not just like nice personality traits. They're actual financial strategies,
Yeah.
powerful ones. That little seed you plant today, given enough time, it really can become a forest.
Couldn't agree more.
Huh.
And maybe the best part is, the future always starts right now. It doesn't matter if you haven't started yet. Understanding this principle today means you can start using its power from this point forward. It's about making time your ally, starting whenever now is for you.
So a final thought maybe for everyone listening, what really stands out to you about the power of compound interest after hearing all this? And maybe more importantly, how might this understanding change your approach to saving or investing as you look ahead? Definitely something worth thinking about as you chart your own financial course.